Welcome to another episode of ETF 360. I'm Tom Lydon with ETF Trends, along with Dave Nadig, our Director of Research. And we've got a special guest, Johan Grahn, who's President and Head of Business Development for Allianz Investment. So, Johan, one of the things we hear from advisors all the time is they're trying to manage their risk, but they're not comfortable just allocating to bonds. Tell us a little bit about what you're doing on that front to help advisors out.
Yeah, sure. No, it's a great problem to have in some cases. In other cases, not so much, right? You have age-old diversification, moving from equities to bonds. You're de-risking portfolios. It's been pretty straightforward. You want to hold a fixed income allocation. You're looking for the yield and the income. Very difficult to do right now, especially when you have equity markets continuously at all-time highs. Really rich valuations, and then you also have inflationary pressure on the bond market side. So we actually see a lot of advisors looking for different ways of managing their portfolios, and there are a few different options for how to do that.
So one of those options uses options, right? That's some of these buffered products that are out there on the street now. You guys have an offering that uses options to kind of turn equities into something that looks a little more bond-like. How should advisors think about where products like that fit in a portfolio?
Yeah, no, it's a good question, Dave. It's one of those things when you have the opportunity to build something that's structured, using options inside of something that's really liquid. You're getting something that's kind of slick in a way that gives you a lot of confidence in terms of how you can invest your assets. And in particular, if you think about, for example, some of the products that we have one buffer with a 10% downside protection. You have another one with 20%. And if you think about the trade-off, right, if you have a buffer portfolio or a buffered equity exposure where you can get exposure to the equity market to up to a cap over a set amount of time, in this case 12 months, but at the same time, if the market comes down by 20%, you don't lose any money. It's a pretty good trade-off, and we find that that it resonates with a lot of advisors, in terms of thinking about how you can replace part of your fixed income allocation into something that might give you a little bit more juice, but at the same time give you enough reasons to sleep well at night.
With all the volatility that we've seen in the last couple of years, Johan, this product offers a quarterly rebalance. So there's a January, April, July, October offering. And if something happens over the course of the quarter, that gives you the opportunity to step in with that allocation. Is that how advisors are looking at it these days?
Yeah, typically, Tom, they look at it two different ways. So you can buy one of those series. Let's say you buy the January one. You can keep that for 12 months. After 12 months, it will reset the cap. It will reset the buffer. And if the market was up, you effectively lock in those gains. And you can also spread your assets across all four of these. That means that every 3 months, if the market comes up, you will lock in those gains, again, without having to realize any gains. Effectively, you're avoiding that tax trigger, if you will. So those are some of the benefits of this. And I'll say too, if I can layer in the idea of expectations going forward on the equity market itself, they're pretty low. So even if you have a cap on a product like this buffer ETF, if the cap is 10% and the long-term expected return on the market maybe is 5, 6, or 7, you can be pretty good off if you can reset and actually lock in any gains that the market's given you every 3 months. It's a really neat solution.
And because these are using options, I'm going to guess that the more volatile the equity markets, actually the higher that cap is going to be. So volatility is actually working for you in this case, right?
Yeah, you're absolutely right. So volatility is a direct driver of the cap that you will get from these products. So it's kind of a neat function, to your point. I like how you put that. When things get really hairy in the equity market, you actually stand a bigger opportunity to get more out of it as it's coming back.
You mentioned when things get hairy. When we talk about buffers, usually Dave and I are talking about our heads. Johan, it's so great to have you with us, and congratulations to Allianz for being in the ETF space. We're thrilled to have you here and look forward to your continued success.